This video is a review of East Japan Railway Co.'s fiscal year 2025 first quarter financial review. East Japan Railway, commonly known as JR East, which is one of the major rail operators in Japan. It was formed as part of the privatization of the state-owned Japanese National Railways in 1987. JR East operates an extensive network of rail lines primarily serving the eastern part of Honshu, Japan's largest island, including the metropolitan areas of Tokyo and the surrounding Kanto region, as well as Tohoku, the northeastern part of the country. JR East is known for its wide range of services, from high-speed Shinkansen bullet trains to local commuter trains. The company is one of the most important transportation providers in Japan and plays a key role in connecting major cities and regions. It is also engaged in other businesses such as retail, real estate, and hospitality. Highlights. On a consolidated basis, operating revenues totaled 686.6 billion yen, operating income 120.5 billion yen, and profit 73.3 billion yen, all of which were significantly higher than the previous year. Due to an increase in railway usage and real estate sales, operating revenues increased for the fourth consecutive fiscal year, and all income and profit increased. By segment, all four segments reported increases in both revenues and income. 35% of net profit was achieved against the full-year FY2025 forecast. All segments' income increased and FY2025 first quarter results was good. Changes in operating income. This is the change in consolidated operating income in the first quarter from the previous year. 27.5 billion yen increased in JR transportation revenues. 4 billion yen is for commuter passes, and 23.5 billion yen is for non-commuter passes. An increase in commuter passes is generally due to increased usage. An increase in non-commuter passes is about 20 billion yen due to increased use, with about a 50-50 contribution from Shinkansen and conventional lines. The effect of the opening of the extension of Hokuriku Shinkansen to Tsuruga is expected to increase annual revenues by 8 billion yen from the previous year, and as of the first quarter, this effect was 2 billion yen, making steady progress. The retail and services, as well as the real estate and hotels, are also increasing their revenues. Regarding the increase in real estate sales revenue, there is no change in the annual sales plan, but a larger amount is recorded in the first quarter due to the earlier sales timing. On an income basis, after deducting costs, the contribution was approximately 9 billion yen. The increase in other expenses includes depreciation, personnel expenses on a consolidated basis, and taxes. As a result, operating income totaled 120.5 billion yen. Segments. JR East's operations are divided into four segments: Transportation segment, Retail and Services segment, Real Estates and Hotels segment, and Others segment. Transportation Railway Services segment. Conventional railways includes the local and commuter trains that operate primarily in the Kanto region, Tohoku region, and surrounding areas. JR East operates multiple high-speed Shinkansen lines in northeast Japan, connecting Tokyo with regions further north, and JR East also operates buses to complement its rail network in certain areas. Retail and Services segment. JR East manages retail spaces in and around its railway stations, such as convenience stores, shopping malls, and department stores. And JR East offers Suica, prepaid smart card, used for transportation and retail payments at station shops and other affiliated stores. Real Estate and Hotels segment. JR East develops and operates real estate properties of station buildings and office buildings near and around their railway stations. Some of these buildings include large shopping malls, hotels, and office buildings. And JR East is involved in developing residential complexes and urban renewal projects near its rail lines. And JR East operates several hotel chain brands, typically located close to their railway stations. Other segment. JR East sells advertising space in trains, stations, and other properties. and JR East is also involved in developing IT infrastructure and providing communication services, partly through their smart card integration. Transportation segment. The graph at the bottom of the page plots the quarterly plan for railway business passenger revenues. The year-to-year figures in this year's plan are expected to drop toward the fourth quarter, as usage increased toward a steady state each quarter in FY2024. For commuter passes, the trend of returning to office has been more advanced than originally estimated, with actual results exceeding the plan at 103.9%. Non-commuter passes for conventional lines were largely in line with the plan. Non-commuter passes for Shinkansen were slightly below plan. Due to the upswing in commuter passes and downswing in non-commuter passes, Shinkansen overall passenger revenues in the first quarter were approximately 107% as planned. In the bus business, revenue increased year-on-year due to an increase in express bus service. In the railcar manufacturing business, revenue decreased from the previous year due to a decrease of railcar sales to non-JR railway companies. Retail and Services segment. In the retail business, the increase in railway usage led to higher sales and profits, mainly in shopping stores, and retail operating revenue was approximately 105% of the previous year's level, in line with the plan. Merchandise sales and food, beverage sales exceeded last year's levels, with 105.7% compared to the previous year. Advertising and publishing sales increased from the previous year due to an increase in transportation advertising sales. Transportation advertising operating revenue was approximately 115% planned and 125% actual compared to the previous year. Although it is still about 65% of the pre-COVID-19 level, companies' willingness of placements is coming back, especially from the beverage industry and manufacturers. Real estate and hotels segment. Shopping centers, offices, and hotels operating revenues were approximately 110% of the previous year's level, almost in line with plans. Real estate value, especially in central Tokyo, has been increasing. JR East owns a large amount of real estate near stations in metropolitan Tokyo and is expected to continue to generate profits from real estate business in the future. These are indicators related to the real estate and hotels segment. Inbound revenues from lifestyle solutions were 10.7 billion yen in the first quarter, out of a full-year forecast of 36 billion yen. There is very strong demand in hotels and shopping centers, especially in the Tokyo metropolitan area. The office vacancy rate fell and vacancy rate was 1.5%. As you can see, hotel occupancy rates and ADR, average daily rate, are strong, especially at metropolitan hotels, where the ADR is now in the 18,000 yen range. Dividends. No change in full-year dividend payment plan for fiscal year 2025. For fiscal year 2025, dividend of 52 yen per share after the stock split is planned, including an interim dividend of 26 yen, for a payout ratio of 28.0%. Increase from fiscal year 2024 dividend of 47 yen, considering stock split in April 2024. JR East's plan is to continue to aim for a dividend payout ratio of 30%, while targeting a total return ratio of 40% over the medium to long term, based on trends in capital expenditures and business performance. Stock price. This is the Japanese yen-based chart for the last 1 year. The Japanese yen stock price is 2,848 yen as of September 30th, and the US dollar stock price is $10.06 as of September 27th. Current PBR is 1.17 and PER is 15.3. Dividend yield is 1.83%. Compared to the last few years, PBR and PER figures are about the same. Dividend yield is higher since dividend amount has been increasing. Conclusion. Although significant growth in transportation business cannot be expected due to increasing remote work after COVID pandemic, real estate values in Tokyo are expected to continue to rise, so expansion in the real estate business can be expected. Large-scale business developments are already underway in central Tokyo, Takanawa, and Shinagawa, with new commercial facilities scheduled to open next year. There is a risk of natural disasters for real estates in Japan. So far, FY 2025 first quarter result was overall good.